What's going on, David?
Just coming back from the holidays. Could have had better weather, but these things happen. It's great now. Looking forward to a really exciting 2023.
Yeah, for sure. And we were just talking about AI.
What an amazing topic. This is going to be one of the big growth fields here as well. That's like, was it OpenAI that you're talking to me about?
OpenAI. I mean, you've got to check this out. Like, there are videos on YouTube right now looking at people writing songs using OpenAI and using specific artist's voice, just like on the spot.
Could be a bit dangerous. Could do some sort of deep fakes on the phone calls
Yeah,
and things like that,
it's
couldn't
all
you?
coming, and all the assignments they have to double check whether or not it's done through OpenAI now. Because you write
Universities
all
have already
your
been having problems with
yeah.
that. They're just going to have to change the way that they do things, aren't
Exactly.
they?
Guys, today we have second episode of Leverage Addicts. And if you guys don't know David, David is an expert investor and have done it a lot in the community. You were in the property investor group. Sorry, what's that? Property
Yeah,
Investor
Auckland
Association.
Property Investors Association president for 4 years and on the board for a decade.
Yep, and he's been on the YouTube channel before, and he's written his own book. Is actually on our shelf.
Oh, there you go,
Invest and
invest and
Prosper.
prosper with.
And today we actually want to talk about capital raising, and not capital raising for massive projects, but capital raising for just the next investment property. A lot of even first home buyers sometimes, because a lot of young couples, what they sort of stuck with the challenge of, hey, I don't have enough deposit, and I got to do it by myself. I don't really want to ask my mum and dad, or maybe they feel like I've asked my mum and dad, but they won't give it to me. What are some ways they could do it? And so, what are your thoughts on asking for mum and dad for a deposit anyway?
Great topic, Blendon. The start, it's always the hardest. Really, really found it, extremely hard. The first sort of $7,000 was far harder to raise than the next 7,000, and it's the same with getting a deposit for a property. Where is the house going to be? How much do you need? It's all a bit scary putting it together sometimes, and you absolutely need to get some expert advisors, which is where the teams at Mortgage HQ and Wealth HQ, I think, do a fantastic job. How do you actually fundraise to buy your first home or investment property? Really important to do it. So one of the key steps there is a sort of, I guess, is a life goal and wealth goal to do it. So how are you going to do that? Well, for so many people buying in big cities like Auckland, it's just not quite enough money to get it together. The bank criteria it might not be quite as easy as well. So how do we get the money together? So sometimes we're going to have to get some friends and family to do it. But what is it? Is it a gift? Is it a loan or what? How do we actually do this? So there are many ways of actually doing it there, but I absolutely sympathise there, and I think it's a really, really important first step to do it for so many, and I think this is pretty crucial for the leverage addicts to get stuck into.
Because sometimes I think the first debate that you have to overcome is like, well, should I do it? Is it right? Am I cheating if I ask for some money? Because some people do get handouts, right? Some people like, and it just makes it an unfair game. And then if you
Yeah,
go on TikTok, you've got a whole bunch of you basically divide the crowd. It's like, hey, you're cheating. Oh, you're so
yeah.
lucky that you got
Yeah,
parents.
absolutely. I didn't have that handout. Would have been nice, but it didn't need it. There for so many people, they might feel proud and not want to do it. But if that's actually holding them back from getting their own home and the feelings of security that they might get from that, or alternatively holding them back from building wealth through an investment property and over time streams of cash flow, as well as growing that equity, perhaps it's better to be open and upfront about and say, "Hey, I need a bit of help." For many parents, sometimes grandparents, even as well as they live longer, they actually want to help. And sometimes I've also heard that they are offended if they're not asked when you needed a little bit of help there. They make assumptions because you dress nicely there that everything's okay, but to them, it's a great gift to be able to give to future generations there.
Yeah, and I think maybe often we approach it the wrong way as well, because sometimes the first thing is, I think, is not asking for a gift or a handout. That's not how we should think about it. We should think about it as a win-win scenario.
Yeah,
And
which could be
when
a loan, for example. So potentially it can get written down rather than being an absolute gift. Writing it down as a loan. There's nothing wrong with being commercial and being professional about it. And sometimes that's actually become really good to have, because sometimes not all relationships manage to last the distance, which is a real shame there. But if it doesn't, the last thing the parents want to do is give the spouse, particularly if it's a cheating spouse, 50% of their money from that gift. So to avoid that, there can be a loan that's written down to acknowledge that, and that can be useful. Hey, when's it getting paid back? What interest rate, if any, is getting attached to it as well? How does it work? So those that I think is a good way to actually do that. I think it's a nice balance. There's for some that are lucky enough to get a gift. That's absolutely fantastic. There are in rare cases do know of a couple of people that have had their parents buy them a lovely home, and that's great. But for so many others, it's a more normal circumstance there. It is becoming more normal to actually help out your kids. Quite frankly, you have to in these big cities now, and Auckland's not the only place there that happens world over, and other expensive and great cities to live in, the likes of Sydney and Melbourne and Shanghai, Beijing, Guangzhou, Hong Kong, and the like. So there's nothing to be afraid of. It's a complete normal thing to do. But potentially, instead of having that as a gift and expecting, hey, here's my hand out there, please get me that money, it's, hey, would I be able to get a loan from you? And actually asking that way is a lot nicer to do it. If your parents or grandparents may all say, well, I don't really want to loan you. The thought of saddling you with more debt when you're getting a big loan, a bit too much for me. How about we do it as a gift? So I think that's a great way to simulate and stimulate
I think
conversation.
you're definitely right, because gifting is one of the easiest way to think about, getting a deposit. Second one is obviously a loan. Loan has got a fixed sort of income, fixed interest. But then once you go out the realm, because like, what are the concerns for the parents? Sometimes they're like, oh, like, I'm scared of getting more loans. They don't want to give out that loan. Like, some parents do think like that. But I think if we start thinking win-win in terms of JV, which is, you're an expert. How could a young couple think about capital raising as a JV with their parents?
Absolutely. This is also a common model increasingly more common model to do it, because of the amounts of money that can sometimes be needed, and sometimes they don't have the income to do it. So sometimes parents there that are working sometimes at the top of their game may need to come on board as a guarantor as well. So if they're putting in equity in the guarantee too, well, that might be that they are actually the dominant partners in this, but because it's their children, they want to help them out. So that can actually be structured as a joint venture. And you're right, I have done a number of joint ventures more on the property development style, which is fantastic. That's a story for another day that I'm excited to talk about. But on this one, it's actually a really good way to be able to help get your children into your home if you're able to indeed do that. And as the child getting that some money from your parents, a joint venture is a great way to do it. You can share in the uplift, share in the risk, have a bit of help with how do we get all the systems done in terms of the repairs and maintenance and the realities of home ownership. That's one way of doing it. Then just think about, hey, when do we want this joint venture to end so we can't get kicked out of our own home there. And just sometimes getting some legal advice is important as well. Just what if the relationship breaks down, right?
That's good. That's good, because you just mentioned a really important part, because from the bank's perspective, a JV, especially if you go, hey, you know, kids, and then you buy a house with the parents, that's not a really good loan to do, because you've got aging parents. They don't often, and they've got their own debts. Maybe their income levels are coming down because they're working less hours. So when they come into this loan application, there's actually not much value in terms of for the servicing. So often the bank don't want to do that loan where it's got the parents and the kids. So legally, how can we structure this? Is there like maybe company or trust that we could potentially do where maybe the parents are not actually guaranteeing, but there's some sort of agreement on the side?
Yep, absolutely. So potentially owning that home in a trust might be the preferred way to do it, and then there could be a separate loan agreement on that, and if it's sold, there could be a profit share attached to
I
it.
need to let the audience know as well that you were an ex-lawyer.
Yes,
before
and
you
plus, like
became a developer?
I was a lawyer. I previously had worked in the tax division of Big Four accounting and professional consultancy firm Deloitte, and then at leading law firm Russell McVeigh. But I've been out of that a very, very long time to enjoy a couple of booms and downturns in the property cycle. So the yes, a bit more a bit of a bush lawyer nowadays, but certainly able to do it, and probably overweight and friends that are lawyers. So happy to share some wisdom there. But there's no substitute when doing the structure like this to actually seek some good independent legal advice. Only because the risks of life do happen. What if your beloved son, daughters, their relationship fails and you've got money into theirs? Well, that can add some complexities to it as well. Sometimes relationships do break up, and some relationships that break up sometimes are a little bit acrimonious, and caveats get put on properties to tie money up as well. So it's not always a fun time. So we do have to be cognizant that there could be some risks. So that's just something to think about.
So would you say in a trust that a lot of these risks would be you could mitigate it if with
Can
the right structure?
mitigate some of the risk because the trust will still keep going on. And the trustees will be the legal owners of the property still. They may well be the borrowers on it there. But that said, if it is say the younger generation that get the house in their, I don't know, late 20s, early 30s, whatever it is, then they split up a bit later on. That's still going to be a bit messed up, that structure, and in many cases that need to restructure the trust to get one of them out. Who lives in the property? Because you can be separated whilst living under the same roof under New Zealand law. Of course, it's just that sometimes that's a bit hard, particularly if there's another partner involved. That makes it a little bit tricky. So what then has to happen to the property? Does one leave the relationship? Is that property sold? So there can be some complexities. In many cases, those trusts are simply dissolved, and there's a split. A couple of these doing that there. But in the normal cases, there that are more straightforward, it can be a wonderful vehicle to have them in that can last for years and decades to come. And a trust's a great coherent ownership vehicle there that doesn't die. It can merely be resettled in 150 odd years' time.
So just thinking, like trying to expand on that, okay, like the risk is like potential relationship issues. If you have a trust, could you actually have some sort of stipulation that's going to allow the parents to be looked after whatever happens in the future, like
Yep.
right from the
Yep.
get-go?
Yep. You can draft that as well if they to do it and put in their capital to do it.
Yeah.
If it's within the means of the trust fund becomes a piece of the trust, then absolutely, then the trustees are bound to follow the trustee,
So that
the obligations to provide for them. Yes.
so in the trust actually is quite flexible in terms of how you can promise a return for the initial capital introduced. Also, who gets paid if something goes wrong.
Absolutely, that can be done, and if not done in the trustee, that would be done in a thing called a memorandum of guidance or a memorandum of wishes. They're the same thing. That's a good way. Basically like a living will. It's a set of instructions about how you want the trust to work, and that I think works quite well. And it's basically highly persuasive, not binding, but highly persuasive on the trustees to take the settlers' wishes into account. The settlers are the people that set up the trust. Might just wind it back there just for the benefit of the audience there that the trust has three parties to it. The first party is the settlor. The settlors, they're the personal persons that set up the trust, and they give that to the second party, who are the trustees. The trustees are the legal owners of the trust fund, and they, in this case, would own the properties on trust for the third party, the beneficiaries. So settlor, trustees, beneficiaries. So those are the three parties to the trust, and that's a common arrangement. I think there are over 400,000 trusts in New Zealand. Not bad for what have we got? 5.1 million people. So there are a number of them there, and many trusts do own a family home, but increasing numbers own rental properties too.
Now, I'll probably oversimplify a little bit, but like in a trust, could you say kind of like trustee is kind of like the director of a company,
Absolutely,
the
they are.
beneficiary are kind of like the shareholders
Yeah,
of a company.
that's
So,
right.
like if we oversimplify it, maybe that's
Yeah,
somewhat the
yeah,
case.
broadly similar.
Yeah,
Yes,
yeah.
absolutely. Trustees make the decision and govern govern the trust fund like the directors would for the assets of the company. And just with a company, companies are more intended to make a profit and to distribute that to their shareholders, whereas the trusts often aren't intending to make profit, particularly if they're just owning an own home. Many people who own in their family trust, they have their home and life insurance policies,
Mm,
for example, in it, and that's
mm.
it.
So we touched on the structure on perhaps raising capital, like, okay, well, you don't have to just ask for a loan or a gift. You could ask for some sort of joint venture agreement. Now,
Yeah,
I guess the next thing we should expand on is like, actually, how are we creating value in a win-win situation for all parties? Like, I mean, let's just think for an example. Let's just think a real case scenario. Let's say we found this multi-units in
sure.
Palmerston North, okay,
Yep,
and it's got 11% yield, okay,
nice
and
yield.
the young couple is got a strong servicing, so they can actually service 70%, like even 100% of the debt, but they
Fantastic.
just don't have the deposit. Okay, so they need 40%. $1 million deal, we're looking at 110,000 of rental income coming in.
Huge. Yeah.
Okay, maybe the net yield before you pay the interest will be around, say, just example, 8%. So
Yep.
we've got 8% net yield. So that means we pay for interest of 6.5. We still got like 1.5% left as dividend if we got 100% finance. So how could we structure this deal so that it's a win-win situation for the parents who, if they lend them 400,000, they still have to pay 7% anyway to the bank because they take it out their revolving credit.
They got it from the revolving credit rather than
Right.
equity funds there as well. That's okay. And on a deal like that, is there then enough cash flow to pay their revolving credit interest off over time?
Yeah. Well, I
Probably,
so it would be on paper after social housing contract, cash flow positive deal. Okay. So let's just say, because this is a typical deal that our client would do, right? $1 million, 10, 11%. There is still leftover cash
yeah,
after you pay 100% finance because
yeah.
it's got interest deductibility.
Absolutely. So say that they might have a, I don't know, they could finance in a few ways. They might do 35, even 40% as equity, but that equity may well come from the largest part of their equity from a loan, there, which is obviously not equity from the parents, and they can get paid their interest rate, perhaps a bit of a margin on top of that as well.
Perfect.
And the that gives them some upside to it. Otherwise, it could just get paid and reimbursed that same amount, give them a profit share or some hybrid arrangement. But
That
it'd be
is
a great way to do it. I think a
so.
profit share would be great on that.
So what you're saying, if I am, maybe I just, lack of a better word, is dumb it down. And what you're saying is you could potentially pay a higher interest rate than what the parents are getting. That's one way. Another way you could say is like just pay them the interest, but also give them sort of an upside, which is maybe they own part of the capital gains on that property.
Absolutely. There'd be a couple of ways of structuring that, and to depend on if the parents are happy to do it. I'm thinking that that deal would be lost because there's not enough deposit there to do it. They couldn't afford to get it, so it'd go to another person. So it's a great deal,
Yeah,
huge cash flow. So to get that, assuming the cash flow is all stable and everything, then hey, go for it. But let's make sure that there's no problems. That revolving credit presumably has interest payable every month. So let's make sure there's money there to cover that.
yeah,
If not, it could get self covered through the revolving credit balance by if there's not regular cash to come in, there'd be enough. Make sure leave enough headroom in the facility to draw down the actual interest against it.
yeah.
But instead of the instead of necessarily looking at it that way, if there was enough headroom to do it in self pay, potentially it could get paid on eventual resale, or alternatively, in a few years' time, get it revalued,
Refinance.
and then you could get it refinanced to repay the money that the parents had put in, and that could be paid at the same rate. It could be paid at a higher rate. That 400,000 in this example might be say, hey, why don't we pay you 500,000 in
Yeah.
3 years' time, or whatever the amount is.
So that's 25% return.
Yeah,
So
yeah.
I just want to unpack a little bit about what you just said there, because the win-win here is that, if they didn't do the deal, the parents would have just got their 400K revolving credit doing nothing. But if they put in this
Yeah.
deal, well, the interest is paid for from the cash flow.
Interest paid from the cash flow. They may or may not negotiate a profit share, which is a chance to get a little bit of a top up, so percent share their success from that. But otherwise, they might just be really happy to help their kids out.
Yeah. I think definitely, the people who are getting the handouts, we're not looking to help those people today.
Yeah, yeah, I'm thinking the same.
But yeah, and so for the kids in this situation is that actually they have created a win-win scenario, because they only borrow 60% on a 10% gross yield. They could easily raise another deal similar like that if they've got other friends and family to give them a similar
Oh,
deal structure.
absolutely. It'll service up well with a huge yield like that. And hey, cash flow is so important. Always more important to have more cash flow in the back pocket at the end of the month than you had at the start.
Yeah. And so I guess one of the things that I wanted to touch on today as well is, because in a deal, against oversimplifying it, there are three major component, three Ds. I talked about this with you earlier, David, and we talked about how we could structure a development deal. But to simplify, the three Ds is the deal itself, the debt, and the deposit. The thing is, to invest in properties, you don't have to have all three, right? Would you agree?
Yes, I do
Well, I mean,
agree.
yourself.
However, there
You don't
are
have to have all
you
three
don't have to
yourself.
have it all through yourself. It's just yes, absolutely. That's an important modification to do it, only because it's now quite rare to have 100% front. So therefore, there is a deposit needed in that. But in some times gone by, we in the lead up to the global financial crisis, there were some 100% loans available, meaning that no deposit was needed. But in property, of course, you need a deal always, otherwise nothing to actually buy as well. And some of the deals that come through, still some of the vendors are in a bit of a time warp, not caught on to the realities of the market there. And goodness, the market is quite different in different places, areas, locations, and property types. And some of the tax rules in terms of new versus old are indeed having an impact on some of the buyer behavior, which does result in some really differential pricing. So
Mm.
need to get a bit of advice and be with some really good trusted professionals as well to make
Yeah.
sure that you get some help in this market there and apply some property intelligence.
Yeah, definitely. So in that situation, you got like the one that we just talked about previously. Basically, the younger couple, they have the deal and they have the debt servicing. They just didn't have the deposit.
Yeah.
Have you done a deal where you outsourced the debt servicing and the deposit, and you just got the deal?
Yes, yes, I
Yeah.
have. I've done
Tell
them.
us a little bit
I've
about that.
done them in the guise of doing them as property development deals, though, where I'm going out and getting, um, say, a property on some large hunk of land, and then I'm needing to go here because I've got my own deals on the go. Everyone's got limited borrowing capacity there as well. Just some people's have a bit bigger than mine, like Elon Musk, for example, there as well. So, but at the end of the day, everybody has their limits and what you can and can't do. And yeah, I hit mine, get close to it. Otherwise, I'm conservative with my chartered accountant wife, and we decide no, can't really take on too much debt. So we are skilled at what we do. I've done over 500 dwellings, never lost money in any of them. Auckland's a great city, 1.7 million people. It's growing. We need housing, and I do like producing housing for people. So I need to get some money. So I need to get a joint venture partner, and that joint venture partner has got something that I don't have. I've got the deal. I've got the experience to as a development manager. I've got a number of resource consents, building consents, manage the divestment phase to get new buildings done and whether sold or kept, and can get tender out construction projects and run a construction program. Absolutely, but I'm not able to fund it, so I need to outsource that. So then I'd come up with a model, which might be a joint venture agreement in a company or a limited partnership agreement for that. And then I'm able to go out and get some really great returns that my investors won't be able to get because they don't know how to assemble a professional team, who to use, how much they cost, and to get a resource consent. That's all a bit scary, to get the building consents and to get the divestment phase sorted out, whether their properties are kept or sold in the market, and then to run that construction tender. So they've leveraged my skill set, they've leveraged my time and expertise, and I've leveraged into their capital and borrowing capacity for it. So those joint ventures have worked quite well. I've done a number of them, never lost a buddy of them. They've been good projects, and they've been actually quite fun to do. The speed of the resource consent something there that's a little bit variable, which is frustrating. But yeah, often these projects take between 18 and 30 months to do it. So say a couple of years, and those projects are actually really good, and they're quite popular and getting some really good returns.
Remind me how many consent you have managed this lifetime?
Building consents well over 500. I've project managed going back with even started doing a few things like minor dwellings and 3 bedroom house, just like 2 lot subdivisions. So around about 100 resource consents that I've got as a project manager for other people since then.
Next time I need to put that in front of the podcast. Just build up
Yeah,
the
it'd be fun to do
they,
that, and we could perhaps share some numbers for some of the listeners
yeah,
that maybe.
we're gonna do a development one next time. But in essence, what you're just sharing is a lot of the time when people are thinking, hey, I don't have the deposit, or I can't serve a small loan because like they sort of get stuck in that mindset of like, oh, I can't do anything. But what you have just explained in essence is, if you look at the three Ds in a deal, the debt and also the deposit could be raised if you had the deal, which is knowledge, right? The deal comes from the knowledge of, not only do you know how to find the deal, but you also know how to add improvement, create new value. And I think that is something that the maybe newer investors sort of get stuck on, and
They do, and can get a little bit scared about this as well. Whereas there's unfortunately there's no prizes for doing nothing. Then you're just stagnating. You actually do have to take action in life, and there are rewards for doing that. And just because something's hard to do, oh, it's hard to get the right deal. It might be that it's an investment property that you're looking for, and you're after the holy grail positive cash flow, or maybe it's you're after something there that you can. By the time you've done it, you've got $100,000 addition to your net worth, which you've never had anything like that before. But never, never, never give in. The most successful people are not quitters. They keep fighting. They never give in. And if you've got that passion and that burning desire, that'll help drive and propel you forward. And that's a really, really critical thing.
one thing I also want to add though, like and expand on that, I think that's the right character and trait. And also one important thing that I see is that they just never stop learning.
Crucial to learn as well. Nobody knows it all. I certainly don't. So make sure that you read widely, have a good network, talk to others there. That way you keep your knowledge constant, you benchmark your opinions, you stay grounded, quite frankly, from taking into account different perspectives as well. They have to be from the right people there as well, because there are some people there that no, you can't do that, and the committees of no, and unfortunately, sometimes family are your greatest critics, and tell you that you can't get investment properties there. I got told, for example, that in my early and mid 20s, I was too young to own properties, and having 3 rental properties that I did then, it's just, no, you can't do that. No, 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 that's bad. And then you're a slumlord, and you get labels like that, which is all just really stupid, sloppy stuff designed to put you down. But when you're on a plan to do it and take action, it's fine. And sometimes it might well be that you have to talk to people older, wiser than you and your friend set to actually help you to do that, because it may well be that by the time you're 30, you might well have wealth more likely that of a 65-year-old, and that's okay. But the catch is, yeah, don't lose sight of the fact that you don't know it all, and that you can get a lot of information there from having a good network of people there and talking to them. And I think that's a really, really important thing. And one of the things is, how do we make sure that we get the get moving, move our life forward, whether it's getting our own home or getting our own property there. Sometimes we don't have all of those elements in terms of those 3Ds. Do we? You got to have the deal, of course, because otherwise no property there to do it. But having all the deposit, having all the debt sorted out there, maybe you need a little bit of help. And increasingly, it's more common to do that. So that's where I need to have a chat to you and the team to make sure they're doing the numbers right, figure out some ways to do it and have that chat. But instead of just asking for the handout, asking for the gift there, ask for a loan. It's much, much nicer to ask for a loan there, and you may well be offered the gift as well. And don't be upset, be humble. If it's a no, not really wanting to do that or need to get legal advice, that's okay.
If you were to give just one advice on someone who's feeling like, oh, not sure if I should ask for a deposit somewhere, they know how to run deals. They've done a couple, they've done a little research, and they see the numbers that works, um, but they don't really quite have what's needed, like the deposit.
Yeah.
How could they approach it? What's one thing they can do right now?
It's a great question, but I think it is to be humble and ask it as a loan. I think it's so much nicer to ask a family member or a really, really close friend. It's like a family member, I guess, that you know has got the value there to ask them for a loan, ask them for a bit of help, talk to them about this deal, talk to them a bit about some of your goals and aspirations, open up to them and talk about how it could work. And if that doesn't work out, they may will say, "Hey, yeah, no problem. We'll just give it to you as a gift." Amazing, but otherwise, do it as a loan. Sometimes if it doesn't work, then do it as a commercial arrangement, as a joint venture. So then they can get some return from it, whether it's as a profit share or an enhanced, I guess, interest rate from it, so they can make some money on their money. Great. There's got to be a way of doing it because otherwise you're going to miss out to do it. And sometimes I think it's just really important to do it. So I think that one piece of advice is be humble and ask them really nicely, open up to them and ask for a loan. Never know what happens there. We're just a little bit short there. I think it's a really good way to do it.
Definitely. I really appreciate that, David. And I do definitely agree. I think sometimes we miss the mark by just thinking about ourselves. First of all, like, I mean, sometimes we're just thinking like, oh, what's in it for me? What's the benefit? Like, I'm just asking for the money for my own benefit. But if we can think in the other person's perspective, well, first of all, like, because you're sort of playing, hey, family wants to help, they're understanding that they want to help. And secondly, if it's not just about helping, actually you could help them by giving them a adequate return.
Too right, and sometimes trust structures are great for this, and some of the best trust ones are actually intergenerational, and they have strategies just like that to actually do it and to help out. And in many cases, the parents want to help out the kids if they just set some rules around it there, and to hope that in turn you'll also look after their grandkids too as well. That they hope to have, hopefully with not too many snow remarks about yeah. So when's my grandkid coming along or anything like that? But I think that it can be arranged really, really nicely to do it, and wish more families would actually get together, be comfortable in talking about money because it is an important subject to have. It shouldn't be this taboo topic. It should be something that we're open about and working together with our goals and aspirations. And quite frankly, in many cases, you'll see this a lot with the B plan, but together, people can be stronger by putting the missing elements in. And for so many younger people, they're often short of a bit of money for that deposit too. So that might be the way to do it.
Definitely. Really, really appreciate your wisdom sharing today. And thanks for jumping on with me today, David.
Thanks, Blandon.
Hopefully, in a couple more episodes later, we got some more in-depth questions about development that you can really, really shine
My
your
favorite topic.
knowledge.
Yeah, can't wait for that.
Thank you. You guys have a great day. And don't forget, if you guys want to learn more about properties and financing, you can check out the Mortgage HQ YouTube channel. Talk soon.